Would Benjamin Graham have trusted private equity's promises of superior returns and value creation? That's the question we explore in this video. Because beneath the glamour of billion-dollar buyouts and boardroom deals lies a simple truth Graham understood better than anyone. Value is not what someone pays, it's what something's worth. In today's markets, where trillions of dollars are locked away in private funds, many investors believe they're escaping the noise of public markets, that private equity offers a quieter, smarter, and more profitable path. But Graham would likely ask a more fundamental question. Are you investing or speculating behind closed doors? In this video, we'll use Benjamin Graham's timeless logic to navigate the world of private equity and leveraged buyouts, revealing how his principles of value, transparency, and margin of safety can help you see through complexity and judge opportunity with reason, not excitement. Because while private equity presents itself as the modern temple of rational capital, Graham's framework exposes how quickly value creation can turn into financial illusion. By the end of this lesson, you'll understand how Graham's definition of an investment would challenge the assumptions behind private equity, why leverage and opacity undermine the very margin of safety that true investing depends on, and how you can apply Graham's timeless standards to assess whether private equity or any investment is built on sound value or seductive narrative. Graham once wrote, "The investor's chief problem and even his worst enemy is likely to be himself." And in the private markets, that truth still echoes louder than ever. To understand how Graham might view private equity, we need to understand what it really is and how it came to embody both the promise and peril of modern finance. Private equity was born out of a simple idea that public markets were inefficient, short-sighted, and burdened by too many rules. By taking companies private, investors could operate away from the glare of quarterly earnings, restructure them quietly, and supposedly unlock hidden value. The logic seems straightforward. If Wall Street was too noisy, step into the silence. The first great wave began in the 1980s. Corporate raiders, soon rebranded as buyout specialists, used massive amounts of borrowed money to purchase entire companies. They'd cut costs, sell off divisions, and eventually return them to the market at higher valuations. It was capitalism's version of flipping houses, but with balance sheets. By the early 2000s, private equity had evolved from an aggressive niche into an institution. Pension funds, university endowments, and sovereign wealth funds all wanted in. The allure was irresistible. Double-digit returns, uncorrelated to the public markets, and a sense of access to an elite corner of finance where ordinary investors couldn't go. But the very features that made private equity appealing, its secrecy, complexity, and distance from public scrutiny, are the same ones that would have made Benjamin Graham uneasy. Graham built his philosophy in an age before financial opacity became a selling point. His greatest concern wasn't missing an opportunity, it was misunderstanding risk. And so the central question becomes, what would Graham think of an investment world that hides its valuations, smooths its returns, and builds its profits on borrowed money? Because behind the sophistication of modern private equity lies an ancient pattern Graham recognized well, the cycle of optimism, overreach, and eventual reckoning. Benjamin Graham drew a line so clear that it still defines investing today. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Anything that fails to meet those two conditions, he said plainly, is speculation. Now let's place private equity on that scale. Private equity claims to create value, but what does that really mean?
In Graham's terms, value cannot be created through clever financing or accounting maneuvers. It must come from genuine, sustainable business improvement.
And yet, much of what drives private equity's returns has little to do with long-term operational strength. It's often about leverage, borrowing large sums to buy companies, improving short-term margins, and selling at a higher multiple before the risk fully materializes. To Graham, this would sound familiar, the illusion of value growth driven not by business reality, but by changing financial conditions. He'd see a system where price often rises faster than worth. Graham warned investors against precisely this kind of confusion. He reminded them that a stock is not just a piece of paper, it is part ownership in a business. The same principle applies here. A buyout is not merely a transaction, it is a bet on the enduring economics of that business. But when returns depend primarily on leverage, on timing, or on accounting adjustments, the core shifts from investing to speculation. Because in such cases, the margin of safety that Graham demanded simply doesn't exist. And without that cushion, without the protection between what you pay and what the business is truly worth, the entire operation becomes a balancing act on borrowed money and borrowed time. Private equity has its geniuses and successes, no doubt. But Graham would ask a humbler, more penetrating question. How much of this return came from real business value, and how much from financial engineering? Because in the end, what matters most is not the brilliance of the structure, but the honesty of the value beneath it. Benjamin Graham approached every investment as a detective approaches evidence, patiently, skeptically, and without illusion. He didn't look for stories, he looked for substance. If Graham were analyzing a private equity deal today, he would start where few in the industry still dare to, the balance sheet. He would ask, what's tangible? What's financed? What's fragile? He'd separate what the business owns from what it owes. In a leveraged buyout, he'd note that much of the purchase price isn't equity, it's debt layered onto the company itself. And that debt doesn't just fund the acquisition, it becomes a permanent guest at the table, consuming future cash flows and magnifying every error in judgment. Next, he'd examine earnings quality, not just what's reported, but what's repeatable. Graham was wary of companies that dressed up temporary improvements as permanent progress. He'd want to know, are profits rising because the business has truly strengthened, or because costs were cut, divisions sold, and accounting adjusted? In private equity, where managers often mark their portfolios to their own models rather than to the market, Graham would demand something rare: verification. He would ask, what is the evidence of value? Who is the independent buyer confirming this price? And above all, he would insist on a margin of safety. Because Graham knew that in investing, mistakes are inevitable, but ruin is optional. The margin of safety to him was not a figure on a spreadsheet. It was a philosophy of humility, a recognition that forecasts fail, economies shift, and confidence can turn to panic in a heartbeat. That is why he taught, the essence of investment management is the management of risks, not the management of returns. In the world of private equity, where risk is often masked by sophisticated models and glossy reports, this mindset becomes not just valuable, but essential. For Graham, numbers alone were never enough. He sought what he called the truth of value, something provable, simple, and real. And when that truth was hidden behind complex financing, he saw danger, not opportunity. If Benjamin Graham were alive today, he would look at the modern private equity landscape with both admiration and unease. Admiration for its ambition, unease for its opacity.
Private equity now manages more than $13 trillion globally. It shakes entire industries, influences job markets, and increasingly dictates the flow of institutional capital. Pension funds, endowments, and sovereign wealth funds depend on it to meet their long-term promises. And yet, the foundation of this immense system rests on something Graham would have found troubling: valuation without verification. Unlike public markets, where price is tested daily by millions of participants, private equity marks its assets internally. Firms model their portfolio values based on assumptions, not transactions. Losses are delayed, optimism is embedded, and volatility is conveniently smoothed away. Graham would see the risk immediately. He wrote that the market is a voting machine in the short run, but a weighing machine in the long run. In private equity, the votes are counted internally, and the weighing is postponed, sometimes for years. He would also question the reliance on cheap credit. For much of the past 2 decades, the private equity boom has been fueled by historically low interest rates. Easy borrowing made leverage seem harmless. But as rates rise, the mathematics of those buyouts change. Debt that once amplified returns now magnifies strain. In this new environment, Graham's caution rings truer than ever. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. He'd remind investors that no strategy, however refined, can repeal the laws of valuation. Paying too much or relying too heavily on borrowed money eventually erodes even the most sophisticated investment thesis. And as more firms compete for deals, paying record multiples for familiar targets, Graham would likely see echoes of the same crowd behavior he warned against nearly a century ago. Different instruments, same psychology. Because when everyone believes they've found a superior system for extracting returns, Graham's voice still cuts through the illusion. The chief danger to the investor is not the market itself, but his own conviction that he knows more than it. For Graham, markets were never just collections of numbers. They were reflections of human nature. Fear and greed, optimism and denial, discipline and self-deception, all visible through prices, earnings, and expectations. Private equity, in many ways, magnifies this mirror. It takes the same impulses that drive the stock market and cloaks them in exclusivity and complexity. The public speculator chases hot stocks, the private equity manager chases exclusive deals. Both, at their core, are seeking validation, to prove they've found an edge others have missed. Graham often spoke of Mr. Market, his allegorical figure representing the manic swings of human emotion. If he were to update that parable for our age, perhaps Mr. Market would have a private equity counterpart, Mr. Model. Mr. Model doesn't show his emotions. He hides them behind spreadsheets. He doesn't panic, at least not publicly. He assigns valuations, projects IRRs, and believes that if the formula is complex enough, risk can be tamed. But Graham would remind us, complexity is not the same as intelligence. He would argue that the emotional vulnerabilities of investors don't vanish when they move from public to private markets. They simply change form, from price volatility to valuation opacity, from panic selling to overconfidence. Graham's antidote to these tendencies was not cynicism, it was character. He believed that successful investing demanded emotional discipline more than intellectual brilliance. He wrote, "The investor's chief problem and even his worst enemy is likely to be himself." In that sense, private equity offers a profound lesson in psychology. It shows how even the smartest professionals, armed with vast data and capital, can still fall prey to the same illusions Graham warned against.
The illusion that value can be precisely modeled, that cycles can be avoided, that success is evidence of skill rather than circumstance. Graham would rightly view today's private equity world as a test, not of finance, but of temperament. Because beneath every leveraged deal and ambitious projection lies a question as old as investing itself. Can you stay rational when the world rewards excess?
If Benjamin Graham were to look at the private equity landscape today, the record-breaking funds, the booming valuations, the aura of exclusivity, he would not be dazzled. He would be cautious, analytical, and above all, deeply curious about what lay beneath the surface. He would not ask, how much money can this fund make? He would ask, what is the margin of safety? In valuation, in leverage, in human judgment. Graham's framework gives us 3 timeless takeaways for understanding private equity and, more broadly, for any form of investing that trades on confidence and complexity. First, never mistake opacity for opportunity. The absence of public prices may hide volatility, but it does not eliminate risk. Private equity returns often appear smoother simply because valuations are marked infrequently, not because the businesses are inherently safer. Graham would remind us that real risk lives not in market movements, but in the permanence of capital loss. Second, the price of exclusivity is often overconfidence. Private equity prides itself on access to deals, to capital, to management. Yet Graham would say that exclusivity can cloud judgment. It can make investors believe they're immune to the same errors that plague the public markets. The very traits that make these deals attractive, scarcity, complexity, leverage, are also the ones that demand the greatest humility. And third, enduring returns come from endurance itself. Graham would see value not in the flash of financial engineering, but in the quiet compounding of disciplined ownership. He would look past the exit multiple and ask, did this company create enduring value? Was it purchased with a margin of safety? Was the investor guided by analysis or by appetite? If you strip away the layers of jargon and the billion-dollar valuations, the essence of Graham's philosophy still holds. Every investment, public or private, is a claim on future cash flows. And the value of that claim depends not on narrative, but on reality. He would likely close his notebook and say something like, the principles do not change, only the scenery does. And as the curtain of modern finance shifts once more, with private equity, venture capital, and new forms of speculation taking center stage, Graham's quiet wisdom still lights the path forward. Investing, at its core, remains a test of reason over emotion. Whether you trade stocks, buy out companies, or hold the family business for decades, the lesson is the same. Seek value, demand safety, and never let excitement replace understanding. Because markets will always change, but the need for rational investing will not. If you found meaning in this exploration of Benjamin Graham's wisdom, how it continues to illuminate even the hidden world of private equity, we invite you to stay with us on this journey. Subscribe and join us in keeping Benjamin Graham's wisdom alive, one lesson at a time, for a world that still needs rational investing.